So today we've got Martine Damonse from Allan Gray. She is an investment specialist there, and she will be giving us a short 15-minute or so presentation on the Allan Gray house view, and also just a brief comments on Allan Gray stable, Allan Gray balanced, that we hold within the select fund range. So I will ask Martine a couple of questions when she's done, but without any delay, Martine, I hand over to you.
Thanks so much, Trevor, and thank you all for joining us today. So I thought we're doing a market overview, and a lot of these are probably truisms that you would have seen from Sunay as well, so it blends quite nicely in with the two presentations. But I think to start, most of you know this as you manage clients, and so I think there's a lot of client management and investor behavior management that's happened over the last 5 years. But ending December, actually, if you had to say your equity return was actually less than cash. So essentially for 5 years, somebody would have been better off in cash than they would have been in equities, and that's obviously a difficult place to be. I think to touch on that, to us at Allan Gray, the most important thing is the price that you pay at the beginning. So price is the most important determinant of future return. And if we had to go back to 2015, if you look at that red line, which is basically your 5-year rolling line, 2015, there were very good returns on the market. And so it's not unexpected that that would have moved downwards as the starting point was quite high. Whereas if you look today in 2020, the exact opposite is true. And although this graph is only till December, if you had to move it towards Feb, actually on a 1-year basis and on a 5-year basis we're slightly ahead of market from a cash perspective. And so that's obviously good news for you guys that look after clients as well. So on an absolute basis, I've just shown you that it's been difficult to be invested in equities over the last 5 years. On a relative basis, you can see that even within the market, if you had to say for the last 10 years, actually the world market has done better than the South African market, that's also quite a difficult conversation to have with your clients. And what clients tend to do and what investors tend to do is they extrapolate what's happened in the recent past and they put all those thoughts into the future. And they say, you know what, the South African market can never do well because it hasn't done well, for instance, for 10 years. What I would caution is that if you looked at the previous 10 years where the graph is upward sloping, that actually means that the JSE did better than the MSCI. And so for the decade prior to this, actually it was the exact opposite. For the short term, so that last couple of months you can see there into 2020, there's actually been a slight reversal again, where the JSE is done slightly better than the MSCI. So on a relative basis, your starting point for the JSE actually looks quite attractive, even relative to the world market and on an absolute basis as well. So Sunay showed a similar graph as well. So you can see that 33% drop in March that Sunay spoke about. And then you can see actually quite a momentous recovery, if I have to say so myself, moving towards new highs on the JSE market to around 68,000 points at one stage. So quite a stark recovery. We actually did not think that the market was expensive prior to COVID. And so as Sunay rightly mentioned, we had started building some positions in some SA Inc. or South African domestic companies at that stage. And obviously during the pandemic that hurt because the South African Inc. companies, along with South African fiscal situation, they were punished, right? But what we have seen over the last couple of months is that with the Biden win, as well as the announcements of vaccines in November, the market turned slightly into favoring a little bit more cyclical, a little bit more emerging market, and that actually worked well for our positioning within our portfolios. But actually, that full picture is not the true picture, because if you had to then split out what's actually done well on the JSE, you can actually see that there's been a small band of stocks that have driven the market upwards. And so if you look at the top bar, that's your red line, that's the top 4. Naspers includes Prosus, that's Richemont, BHP, and Anglo American. You can see then that your gray bar, which is your ALSI line, is actually reasonably flat, slightly peaked upwards, as Sunay mentioned, after the crash. And your blue line still looks reasonably depressed if you compare the starting point, which was actually in 2016. And so what does this say? It says, actually, the 4 biggest stocks in the market, if you include Prosus' 5 biggest stocks, actually drove the returns of the market. What you could also add is that the precious metal miners, which has done exceptionally well in the last 2 years, they're still in the green bucket or the green line. And actually, if you took them out, that line would be even further depressed. And so what we're finding is, yes, we do have favorites in those big stocks. So Naspers is one of our biggest holdings, for instance. We've got small positions in BHP and Anglos, and we do own precious metal. But the things that are quite attractive, we're finding in that very depressed blue line at the moment. I think just as a caution, not everything is attractive and some things are cheap for a reason. So we're exceptionally cautious about what we've chosen in the South African market. But we can say there are very attractive opportunities up for grabs, even after some of the reversal and sort of South Africa doing well after November. So why do we have so little in Anglos and BHP? So the one thing is, when we look at companies, we're not choosing them simply because they're big in the market. You're obviously choosing them because from a bottom-up basis, they look attractive. And so one of the biggest drivers of return and profit for BHP and Anglos is actually iron ore. So the iron ore price is exceptionally important in their lives. And what we found over the last few years is that we found that the iron ore price was actually quite high. And in the last 1 year, actually, so if you look from Jan to Jan, 2020, the 31st of Jan, to 2021, the 31st of Jan, actually that price almost doubled. And so even within the difficulties of COVID, supply constraints, China demand, those things actually exacerbated the price movement for iron ore. And so even though on a relative basis it's hurt not to have more in Anglos and BHP, we think if you normalize these prices, we'd be much happier to continue owning something like Glencore, which is also a diversified miner, but they have a very different commodity basket. They own no iron ore, but they have large positions in, for instance, copper, coal, zinc, nickel, and cobalt, and those are very well placed to be able to support a decarbonizing economy. The other thing and the other place that we're finding quite a bit of value is in the financials. And so this chart basically shows you the financials relative to the ALSI, and it's at one of the lowest points, if not the lowest point it's been in basically the life of the JSE. And so if you're looking at this, you're thinking maybe it's right? Maybe South Africa has fiscal concerns, maybe our growth rate is low, maybe these are justified. But actually when we look at them and we look at the underlying companies that this represents, not all the companies obviously are as attractive. But if we look at the banks, for instance, banks have traded on reasonably low multiples just before COVID as well. And so we did have a small position in banks. After COVID, we actually topped up on some because they were trading as depressed businesses. And actually our banks in South Africa are incredible businesses. They're very well capitalized and they really are well suited to make good returns in the future. We do think the next couple of months or the years are possibly tough as earnings look still a little bit depressed based on the economy sort of slowly opening up. But we do think for the price that we paid, these are incredible investments. We also own things like the holding companies, Remgro, Raynet, and these also fall into the financials, which we think are incredible opportunities for investors. Somewhere else, and this is sort of the worst kept secret in the world, I think, at the moment, is South African bonds are offering exceptional returns for the 10-year bond on both a nominal basis, which is basically the absolute number that you're getting, as well as an inflation adjusted, so a real basis. You're getting an incredible return, unlike anything else in the world. And so what we did do this last year is, as you see that spike in Feb, you saw yields move to around, there you can see around 11% on the 10-year number. We actually increased our weighting towards long bonds, taking advantage and locking in some really good returns for our clients over that period. And you can see, even though the market has come to readjust and the yields have gone down a little bit, that inverse relationship between, your bond price and your bond yield has come into play as well. And so you lost a lot of money in March if you had lots of long dated, but since performed reasonably well. And so South Africa, I've just mentioned that on a relative basis, even South African bonds are looking attractive. Global bonds, if I had to just explain this chart quickly, the dark blue line essentially is your axis, which shows you the 10% to the 0. And that essentially says, at the moment, if you look into the corner where it's lowering, that means that actually global government bonds at the moment in developed markets especially, these are giving you less than a 1% yield at the moment, right? But the risk that you're taking, which is the light blue line, which is duration, and that's ticking upwards, you're taking on a 9-year duration. So what does that mean? It means that your sensitivity to interest rate increases, which is essentially what duration is. It's saying if there's a 1% increase in your yield, right? So if bond yields go up by 1%, actually your price of your bond is going to go down by 9%. That's quite a big risk that you're taking. And so in our portfolios on the global side, we own no global government debt. This has been a hard thing to do because these have performed brilliantly through quantitative easing. As yields have moved downwards, price has gone upwards. And so a difficult place to be, but fundamentally, we don't believe that this makes sense for a long-term investor. If you then had to say, what does the offshore market look like? Actually very similar to the South African in some respects. You've got this massive, massive outperformance by the big stocks in the US. You could earmark them. You could say the FANGs. You could say some low volatility stocks as well. And these have just been incredible performance. You can see that dark blue line showing you the biggest 50 in the US. And then the light blue line actually showing you what we call the world equally weighted stocks. And actually on an equally weighted basis, stocks on average have only just reached their 2018 numbers recently. And so actually on a global basis, even though we as a business, we think that the US is, for instance, on a top-down, the indices are quite overvalued, there is definitely pockets of value offshore to be found still. And those are mostly in the bottom line, where on a world equity basis, you can actually get lots of return and many things that we think are still depressed. If I had to show you what our carve-out looks like, so this is the best proxy that I can show you for the offshore component of both balanced and stable. The Global Balanced Fund, which Orbis manages, this is the largest component of both offshore carve-outs of both funds. And as I've just mentioned, it's not surprising that we think the US is expensive, that we have a very big underweight position towards the United States. So that 28% in comparison to around 50%, 57% for the 60/40 index. On the other hand, we are finding emerging markets quite attractive. And so we've got a big overweight position towards those. So about 23% in comparison to the 60/40, which has roughly 0. So very different to the 60/40. And as I've already mentioned, you've also got your bonds, which we own no global government debt. We do have some inflation linkers, but we own no global nominal bonds. And so a very, very different looking portfolio, even on the offshore side, within these funds. And so to us, this is probably your biggest relative opportunity within the Allan Gray funds, as possibly this offshore side being very different to the market. If we look at the balanced fund in totality, so we're looking at the asset allocation based on everything we've just spoken about, we think that SA shares, very, very selective, cautiously adding to, SA shares look attractive. So that darker grey bucket, that's your SA share component. Your light grey bucket is basically your SA bonds and cash. And so together that makes up with your property a more SA focused risk, right? So if you have the rand blowout, this is the portion that will probably struggle the most. On the flip side, if EM does well, this is probably the portion that's going to benefit the most. In red, you have things that are more exposed to rand weakness or that will benefit from rand weakness. And that includes your offshore bucket, and that's split up between different asset allocations managed by Orbis as well. You've got some Africa exposure, which is also dollar-based, precious metals, which are mostly priced in dollars, so they also have a rand-hedged component. And then South African shares, which have nothing to do with South Africa. So those are your big positions, things we really like, things like British American Tobacco, which is our biggest overweight compared to the market. You've got things like Glencore, things like Naspers, things like Sibanye, where the metals actually benefit from rand weakness as well. If we then had to look at what the stable fund looks like in comparison, as you'd expect this to have a little bit more, sorry, I see one says category name that probably just fell off, but that is your Africa component, that's around 6%. if you look at SA bonds and cash, and if you add the offshore bonds and cash, that is almost a 50% exposure to bonds and cash. And so for a more stable type investor, more cautious investor, it's not surprising that you have a little bit more exposure to assets that move a little bit less volatile. And then we also have, obviously, a rand hedged component, having offshore exposure, and then your South African domestic businesses, like your banks, your insurers, and some of your industrials, as I've mentioned. And so that's essentially our view. I know, obviously, there's a lot more that could be said, but we do think that the South African market is offering opportunities. We do think on the offshore side that even though it's been a tough period for Orbis, they are very well positioned to be able to take advantage of any normalization of these big trends we've seen in the market recently, things like value and growth, cyclical versus defensive, these big gaps between expensive and cheap. And so we quite excited about the opportunity in the portfolios. And yeah, thank you for the opportunity to chat to you guys.
Thanks a lot, Martine. So just a couple of questions from me. I'm just aware of time. We've got 5 minutes. You touched actually right at the end on them. So I've got 2 questions. The one, it was on Orbis. So we know that Orbis, I mean, they've got an unbelievably long, amazing track record. Yeah. But recently, I guess the last 3 years, although they had a good 2018 or 19, I think it was, but they've struggled a bit. So I think you partly started answering the question a little bit now. Just first of all, as a person based in South Africa, how have Allan Gray clients, where the Allan Gray funds are, of course, investing into Orbis for the global portion, just how is the market sort of feeling about Orbis? And then just going forward, where does Orbis feel that they're going to, I guess, make up that lost ground? So that's my first question. And while you're answering that one, your brain can think of the other one, which is just, again, within Allan Gray and your local investment team here, you have had a few staff changes and movements. Do you just want to highlight, what those key changes were and how is it all going after these changes?
Absolutely. Thanks, Trevor. So yeah, let's touch on Orbis Performance first. So Orbis and Allan Gray, obviously, we've got exactly the same philosophy. And so it works quite well that we understand each other very well. In Orbis's universe, it's a little bit larger, so you do actually have that benefit of looking very different to the market, and that's exactly where they found themselves. And so in the last 3 years, so the period is sort of from 2018 to 2021, if I can break them up. In 2018, there were some mistakes, but also just things went wrong. So in idiosyncratic things in specific companies went wrong. And actually, in that period of underperformance, we reinvested into some of those companies. So like XPO is a good example, AbbVie is a good example. And so we actually upweighted the things that we liked. In 2019, as you rightly said, the absolute performance was more or less okay. It was almost in line with market, but actually on a relative basis, you were still under, right? So you never caught up to 2018 numbers. And then in 2020, actually, we were very poorly positioned going into the crisis. And the reason I say that is because I've mentioned we were underweight the US. The US continued to do well. You were underweight the FANGs, which basically drove the market throughout the crisis, and we were overweight EM and cyclicals. And so you may ask, why were we positioned in that way? Why does that make sense? And actually, if you looked at the MSCI and you broke up the last 3 years and you had to say, what drove the market? More than anything else, it's actually been the re-rating of stocks and not actually the earnings of the underlying stocks going up. And so that's what we see as fundamental investors. We're looking at what is the benefit that you're going to get based on the fundamentals that you can see. And so the price that we were looking to pay for FANGs at the time, I mean, we do own some. We own Facebook, for instance. The price that you're willing to pay was not meeting what we thought they were worth. And so we're happy to not own them, but it did hurt, right? More recently, as you saw, as I've mentioned, the Biden win and the vaccinations, you've seen a little bit more of a move into where Orbis was positioned. And so sort of from November into Feb, we've actually seen quite a sharp reversal into things that we are positioned in. And that's been quite nice to see quite a sharp movement in performance. For instance, the Orbis Global Balanced Fund is now ahead of benchmark over 1 year. So it is a short-term period, but I think importantly, the things that we look towards, so the fundamentals, didn't make sense for the things that were doing well. And so, yes, you hold your fort and you held tight. It has obviously been painful, but at the end of the day, we do believe in the way that Orbis invests, and we did think that it was the right way to be positioned, even though it hurt while you were there.
Great, thank you. So I'm going to get you're going to get back to the staff one.
Yes.
Just last, perhaps slightly investment question. One of the areas again that I guess differentiates a little bit Allan Gray is you had it in your pies is the Africa exposure.
Yeah.
Without going into massive detail, can you just give us a bit more information on how they're investing and where, etc.? And I mean, you did show the weights. It's about 3 to 6%.
Yes. So the Africa Fund, and I'm very happy to send you guys some more information, the ex-Africa, that is managed here in South Africa. So our team manages that fund, and they've got various exposures throughout Africa. But I think like a good example, for instance, is holding something like a Nigerian bank, where actually a lot of people wouldn't think that's a good investment, but because of that, it can be. And so I think some of the things that sort of we look towards is active management works very well in Africa because it's very under-researched. And so, sorry, not banks, I mean to say bonds. So the point there is that you don't need to have something that somebody knows very well in order for it to do very well, because active management, we go and do our own research. And so things like something in Zimbabwe, which even though Zimbabwe is in a bad state, you can still find good investments. And so quite diversified from an African perspective, but we do have pockets of value that we prefer.
Great. Do you want to just touch on to end off the
staff changes? Yeah, so last year we did have quite a few staff changes. And I mean, I know that for clients it can be a bit disconcerting seeing people leave all at once. But I think the benefit of our system is we've got this multi-councillor approach. And so what that means is if somebody leaves, somebody else easily slots in because you don't have this one star manager. You've got a mix of ideas that get aggregated up into one portfolio. And so last year we had our CIO, Andrew Lapping, who'd been with the firm for 20 years. He decided to immigrate with his family, and he's no longer in investment management either. We had, for instance, Leonard Creer and Mark Dunley-Owen also left in the last 1 year. And then more recently, Ruwan decided to stay home with family and to almost just do his own private investments. And so as disconcerting as that may be, we also feel every single one of those managers played a very important role in the portfolios. They stayed with Allan Gray for a long time. They've been added great value to the portfolios, and departures are inevitable. Right? They're not fun, but they are inevitable. And so we're very confident in the talent that we've brought up and the talent that we've been able to promote, and we're very grateful that we could promote them as well at a point where it seemed right. So they are ready for these positions. And then obviously Duncan, who's everybody knows, and most of your investors would probably know him quite well as well. He's been with the firm for 20 years as well, and so very, very ready to take over the reins and add some of his own mix to it. And yeah, the team has done really well. So very cohesive, managed to transfer all the portfolios seamlessly to the new PMs. And as I said, as difficult as it may be for somebody else to hear, you know, that their investment team changes, we do have quite a robust portfolio management team in terms of the analysts as well. So the analysts we've been able to promote have actually been quite senior even compared to history. And so we're quite grateful we had the opportunity to have a deep bench to be able to do these changes and feel that we can continue to build clients' trust and do well in the future as well.
Martine, thank you very much.
Thank you.
Our timing is perfect. We've got 1 minute to go and we'll be finished on time at 12:30. So thanks very much to you and to Sunay for interesting presentations. Hopefully all of you who are attending have found this useful and interesting. So we will be holding 2 more of these select top table events. I think the next one is in June and then around September or so. So watch out for the invites for those, where we will have some other fund managers that are used within the select fund range coming to present as well. So thank you very much. Hopefully you all found that interesting. We will be also holding some more formal training and rollout type of sessions on the Select Global Fund, as well as, I guess, the whole range, and setting it out with Nedbank Private Wealth guys as well in terms of their advice-led investment framework. So with that, thank you. I would like you to all, just when you sign off now, there is going to be a little code coming up on your computer there with your phone. If you can just click on it and do the questions. It takes about 30 seconds. It's really short, sharp, and simple, and gives us great feedback. So if you can just scan on that QR code, would be great. Thank you, everybody. Thanks for your time. Have a good rest of the week, and stay well and stay healthy. Cheers.